Among the pantheon of trading legends, few stand as tall, or as instructively, as Jesse Livermore. His life was a testament to both the immense potential and the devastating pitfalls of speculation. He made and lost fortunes multiple times over, experiencing both exhilarating triumphs and crushing bankruptcies. It was through these profound highs and desperate lows that he distilled a wisdom that remains as relevant today as it was a century ago. Livermore's insights are not theoretical constructs, they are the battle-hardened observations of a man who grappled directly with the market's raw power and the complexities of human nature within it. Subscribe now, leave a like, and write any comment. This way, you'll help more people see and hear this message, and I'll know that my work is not in vain. The initial enchantment of the market blinds many to its inherent dangers. They see only the potential for profit, overlooking the omnipresent risk of capital erosion. This naivety is often compounded by a belief that intelligence or quick wit alone will suffice to outmaneuver the market's forces. However, Livermore understood that intellectual prowess, while helpful, is secondary to a deeper understanding of market mechanics and, more importantly, human psychology. The true education in trading often begins not with a win, but with a loss, a humbling realization that the market operates on its own terms, indifferent to one's hopes or expectations. Therefore, for those who truly wish to survive and thrive in the unforgiving world of trading, it is imperative to confront these hard-won lessons head-on. Do not wait for painful experience to force them upon you. Understand that the market's greatest teachings are often delivered through the sting of defeat. Embrace the wisdom of those who have walked the path before, for their insights can illuminate the hidden traps and guide you towards a more disciplined and ultimately profitable approach. The journey to consistent success in trading is a continuous process of learning, adapting, and, above all, mastering oneself. The greatest battle in trading is not waged against the market itself, but against the tumultuous landscape of one's own emotions and human nature. Jesse Livermore, with his vast experience of soaring gains and devastating losses, repeatedly emphasized that the biggest enemies of the speculator are not economic downturns or unexpected news, but rather the deeply ingrained human tendencies of fear, greed, hope, and pride. These powerful emotions, when unchecked, can obliterate even the most meticulously crafted trading strategies, leading directly to irrational decisions and catastrophic losses. Greed drives individuals to hold on to winning positions for too long, hoping for even greater profits, only to see them evaporate as the market reverses. It also compels them to overtrade, to chase every perceived opportunity, leading to impulsive entries and increased exposure to risk. Conversely, fear paralyzes decision-making, causing traders to sell too early out of panic, missing significant gains, or to avoid entering promising trades altogether. The fear of missing out, FOMO, and the fear of loss are potent forces that can hijack rational thought, transforming disciplined traders into reactive puppets of their own anxieties. Perhaps the most insidious of these emotions, as Livermore observed, is hope. This seemingly benign emotion becomes a destructive force when applied to losing positions. A trader clinging to hope will average down, buying more of a falling stock, desperately wishing for a reversal that rarely comes. Hope whispers false promises, encouraging one to disregard stop-loss limits, to ignore mounting evidence of a flawed trade, and to believe that this time it will be different. It transforms a rational speculative venture into a desperate gamble, often leading to the complete erosion of capital. Pride also plays a significant, often overlooked, role in a trader's downfall. The pride of being right, the reluctance to admit a mistake, can prevent a speculator from cutting losses quickly. Instead of acknowledging an error and exiting a losing trade, pride compels them to hold on, convinced that their initial analysis must eventually prove correct, often at immense cost. This ego-driven resistance to admitting error is a deadly flaw in the unforgiving world of speculation, where quick adaptation and humility are paramount for survival. Therefore, the first and most critical lesson in trading, often learned too late, is the absolute necessity of emotional control. It requires a profound understanding of one's own psychological makeup and a disciplined commitment to acting against natural human impulses when on the trading floor. Every decision must be rooted in logic, analysis, and a predetermined plan, rather than swayed by the exhilarating highs of success or the crushing lows of defeat. The true mastery of trading begins not with conquering the market, but with conquering oneself. Among the most difficult, yet profoundly critical lessons in the realm of speculation is the undervalued virtue of patience and the art of waiting. The market constantly broadcasts a cacophony of opportunities, tempting the eager speculator to act, to always be in the game. Yet, Jesse Livermore, through his extensive experience, discovered a counterintuitive truth. Most of the time, the wise speculator should be doing nothing at all. Profit is not generated by constant activity, but by the disciplined ability to wait for the absolutely right conditions to present themselves. This deliberate inaction, far from being a weakness, is a cornerstone of true market mastery, often learned only after significant losses. The restless nature of human beings naturally chafes against idleness. There's an inherent urge to be productive, to be engaged, to capitalize on every perceived fluctuation. However, Livermore stressed that the vast majority of market movements are merely noise, irrelevant to the larger trends that generate substantial profits. Attempting to trade every little wiggle leads to overtrading, increased commissions, and ultimately, a dissipation of capital. The true capital, he famously noted, is made during the waiting. It's made through the patience to sit idly by, observing, studying, and conserving one's resources until the truly opportune moment arrives. This concept is intrinsically linked to Livermore's idea of key points. He believed that a market, or a particular stock, would reach certain pivotal moments where its future direction became unmistakably clear. These were the only times worth committing significant capital. Prior to these key points, the market was often choppy, unpredictable, and a graveyard for premature entries. The speculator's task was not to predict every turn, but to recognize these decisive moments when they emerged and then act with decisive conviction. Waiting for these clear signals required immense discipline, resisting the urge to jump in merely because one felt compelled to do something. Impulsive decisions, driven by a desire for immediate gratification or fear of missing out, are the bane of the impatient speculator. They enter trades without sufficient confirmation, hoping for a quick profit, only to find themselves caught in adverse movements. This incessant need to be in the market, to always be active, demonstrates a fundamental misunderstanding of how real money is made in speculation. It is not about constant trading. It is about making a few, highly accurate, well-timed trades that align with a powerful underlying trend. These are rare opportunities, and waiting for them is paramount. Subscribe now, leave a like, and write any comment. This way, you'll help more people see and hear this message, and I'll know that my work is not in vain. Therefore, the invaluable lesson often learned too late is that patience is not a passive trait in trading. It is an active strategy. It demands discipline, keen observation, and the strength of character to resist the market's constant temptations. The speculator who masters the art of waiting, who can sit through periods of apparent inactivity, conserving capital and mental energy, is the one who will ultimately be positioned to capitalize massively when the truly significant opportunities present themselves. Do not confuse activity with progress. In speculation, often, the most profitable action is intelligent inaction. Beyond psychological control and the discipline of patience, the ultimate determinant of a speculator's survival and longevity lies in their rigorous adherence to capital and risk management. Jesse Livermore understood, often through the most painful lessons of bankruptcy, that protecting one's capital is the absolute first law of speculation, overriding all other considerations. The market will always present opportunities, but if one's capital is gone, the ability to capitalize on those opportunities is permanently lost. This principle, seemingly simple, is shockingly difficult for many to internalize, leading to the untimely demise of countless trading careers. One of the most dangerous and common errors, frequently learned too late, is the practice of averaging down. This destructive habit involves buying more shares of a stock that has fallen in price, hoping to lower the average cost and profit when it eventually recovers. Livermore vehemently warned against this. He famously stated, "Never average losses. Average profits." Doubling down on a losing position is akin to throwing good money after bad, transforming a small, manageable loss into a potentially ruinous one. It is a desperate act born of hope and a refusal to admit error, and it has destroyed more accounts than any other single mistake. Central to effective risk management is the disciplined use of a stop-loss. This is a predetermined point at which a losing trade is exited, cutting off further losses. Livermore understood that accepting small, predefined losses is not a sign of weakness, but an act of profound strength and financial prudence. It prevents a bad trade from becoming a catastrophic one, preserving the capital necessary to participate in future, more profitable opportunities. The speculator who fails to implement and adhere to stop losses is gambling, not speculating, and their eventual ruin is merely a matter of time. Furthermore, a critical aspect of capital management involves limiting the size of one's exposure in any single trade. No matter how promising a setup appears, no single trade should jeopardize a significant portion of one's total capital. Risking too much on one venture exposes the speculator to the inevitable vagaries of the market and the inherent unpredictability of even the best analyses. A prudent speculator understands that even the most well-researched trade can go awry, and they prepare for this by sizing their positions defensively, ensuring that a single loss, however large in percentage terms, does not cripple their overall trading ability. In conclusion, the ultimate safeguard in the tumultuous world of speculation is an unwavering commitment to capital preservation and stringent risk management. It means accepting small losses quickly and ruthlessly, never averaging down, and never risking too much on a single venture. These are the defensive strategies that ensure survival, allowing the speculator to remain in the game long enough to capitalize on the rare, truly profitable opportunities. The lessons of risk management, though often learned painfully, are the last frontier of trading mastery, distinguishing the enduring professionals from the fleeting amateurs. Perhaps the most humbling, yet ultimately the most invaluable, lesson in the demanding world of trading is that defeats are not merely inevitable, but are the most potent teachers. No speculator, regardless of their genius or experience, can avoid losses entirely. The market, by its very nature, is unpredictable, and even the most meticulously researched analyses can be proven wrong. What distinguishes the enduringly successful from the ephemeral failures is not the absence of losses, but the disciplined ability to extract profound wisdom from every setback. These painful experiences, often the very ones that drive lesser individuals from the market, become the crucible in which true trading mastery is forged, though the tuition fee is always paid in capital and emotional fortitude. Jesse Livermore, who experienced the dizzying heights of unparalleled success and the crushing lows of multiple bankruptcies, understood this truth perhaps better than anyone. He learned, at immense personal cost, that pride and the refusal to admit a mistake are far more destructive than any market downturn. The human ego often compels one to cling to a losing position, stubbornly convinced that their initial judgment must eventually be vindicated. This stubbornness, this unwillingness to acknowledge error, transforms a manageable loss into a complete financial disaster. Livermore's most significant advancements in his trading methodology often followed his most brutal setbacks, as he was forced to re-evaluate every assumption and rebuild his approach from the ground up. The critical step in transforming defeat into a valuable lesson is objective analysis. When a trade goes wrong, it is paramount to resist the urge to blame external factors or to fall into self-pity. Instead, every losing trade should be meticulously dissected. What was the original thesis? What signals were missed? What emotional biases might have influenced the decision? Was the risk management plan adhered to, or was it abandoned? This dispassionate examination of failure is the only way to identify flaws in one's strategy, psychology, or execution. Without this rigorous self-assessment, the same mistakes are destined to be repeated, leading to a perpetual cycle of losses. To facilitate this crucial learning process, Livermore implicitly practiced what modern traders call maintaining a detailed trading journal. This involves recording every trade, the entry and exit points, the reasons for entering, the stop-loss levels, the emotional state, and the ultimate outcome. Such a journal transforms vague recollections into concrete data, allowing for a systematic review of performance. It provides an objective mirror, reflecting one's true trading habits and revealing patterns of error that might otherwise remain unseen. This disciplined record-keeping turns every loss into a valuable piece of educational material, preventing the same tuition from being paid repeatedly. Ultimately, the mark of a true master speculator is not the absence of losses, but the wisdom gained from each one. They understand that every setback is a test, an opportunity to refine their strategy, strengthen their discipline, and deepen their understanding of the market's immutable laws. The man who learns from his mistakes, who allows the sting of defeat to sharpen his resolve rather than break his spirit, is the man who ultimately endures. For in the unforgiving arena of speculation, the most valuable lessons are those learned at the highest cost, transforming temporary defeats into the foundational pillars of lasting success. Subscribe now, leave a like, and write any comment. This way, you'll help more people see and hear this message, and I'll know that my work is not in vain.